All right. Welcome, everyone. Thank you for joining Private Credit and the Dangerous Rise of Unregulated Finance, the latest installment of the speaker series hosted by Americans for Financial Reform Education Fund. My name is Natalia Renta, and I am the Associate Director of Corporate Governance and Power here at AFREF. Today, I'll have the pleasure of being in conversation with Lenore Palladino, Associate Professor of Economics and Public Policy at the University of Massachusetts Amherst, and author of Good Company: Economic Policy After Shareholder Primacy. She's also a longtime friend of AFREF. Our conversation today will center around private credit as more and more companies are raising money in the growing private credit market rather than from banks. We'll be discussing the implications of the growth of unregulated credit for retirement savers in our entire financial system. Unfortunately, this is an extremely timely discussion. I myself have been having a hard time keeping up with all the recent private credit news. As concerns that AI will disrupt the software industry have come to the fore, major private credit funds have limited investors' ability to tap into their savings. Large investors have also taken losses from loans they've extended to companies that turned out were committing fraud. Stocks from firms that manage private funds have slid, as have those of major banks, due to concerns over their exposure to private credit risks. All of this, of course, while the industry is pushing to shove private markets into 401ks. So let's dig in. So I'll be asking Lenore a series of questions, but we'll also have an opportunity for a Q&A at the end. So as you have questions, feel free to pop them into the Q&A. So Lenore, let's start with the big picture, and thank you so much for being with us today.
Sure.
So what is private credit, first of all, and how has it evolved in size since the global financial crisis?
Yeah. So thanks for having me. It's always fun to be with AFR. And I've been, as Natalia said, a big fan and participated since 2009. Hopefully, we're not back in those days. So I'm going to give a little bit of setup that answers that question by starting a little bit more broadly. I'm looking at the attendees that I know some of you know the structure of private markets and private funds very, very well. And some of you may have decided to attend this webinar because you have really no idea why it's called private credit. So I'm going to give a little bit of context and then narrow in on specifically private credit funds. So, in the last decade, we've seen this rapid growth of what we commonly call the private financial markets. And right at the outset, I'm going to sort of quote around private because when we say in finance, public and private, it can be really confusing, right? Because by public, we don't mean governmental, right? We don't mean public in the sense of this is, like a public institution that's led by a democratic government, right? We mean public in the sense of open financial markets that are available to anyone versus the type of financial markets that we're talking about today, the sections of the financial market that are really limited historically to a certain segment of the investing public. But we've seen in the last decade this growth in what I often refer to as unregulated or lightly regulated finance. This is the part of the financial markets that does not trade on open exchanges such that anyone can buy in. And it's been growing incredibly rapidly. We're probably most familiar with private equity. We've had a lot of conversations and campaigns and policy interventions around private equity over the last many years. And now we're here to talk about private credit funds, which are a related type of institution. But it's useful to get an overview of this whole structure of the financial system to understand how private credit funds fit in. So for nearly 100 years, we've had this division in our economy between regulated banks and exchanges, financial exchanges, stock markets, and private markets, these limited markets, to protect ordinary households and the broader economy from the risks that financial actors take when they don't have to disclose what they're doing, right? There's a lot of risk that can build up when you can take all kinds of activity as a financial institution and don't have to share what you're doing with the public. What's so important right now is that this barrier between the public and private, or the open and closed or less regulated sides of the financial market, this barrier has collapsed. And so unregulated finance is flooding in to touch all sectors of our economy, non-financial corporations, our own retirement savings, public pension funds, all kinds of institutions. But why did we have this barrier, this distinction in the first place? It's because of the economic catastrophe of the Great Depression, right? So to take us all the way back to 1929 and through the 1930s, we had, of course, a major financial and economic collapse. And there was a lot of work at the time that went to, really the first time we built up major financial regulatory institutions. We can talk about this in the Q&A if people are interested, but we have a whole set of what we can think of as our New Deal financial regulations, the Securities Acts, the Investment Company Act, Investment Advisors Act, that really in different ways institutionalize this public and private divide in the financial markets. And, just to be a little bit repetitive, the point of it was to establish this highly regulated public realm and then this lightly regulated private realm based on the premise that if you're going to have these open public markets, you have to give the people who are going to be putting their hard-earned money into these markets detailed disclosure of financial activities by non-financial corporations and by financial institutions. Private markets were assumed to be the domain of wealthy expert shareholders, so they did not need all that disclosure, right? The accredited investor has to be definitionally wealthy in order to engage historically in the private markets. So just to say what we traditionally think of as the public markets are the stock market, the New York Stock Exchange, the NASDAQ, and the regulated banking system, right? We've had so much work that we all put in around Dodd-Frank to put in place new kinds of regulatory structures around the banking system after the collapse that we had in the 2000s, right? But that barrier, still stood. What I've been really concerned about, and I think why many of us are really concerned about right now, is the fact that the center of gravity in finance has shifted in the last 10 years to be much more centered in these unregulated or private financial markets. So private funds, which I'll define in a second, have approximately tripled in just the last decade to hold $26 trillion of gross assets, up from $10 trillion in 2015. This is according to the Securities and Exchange Commission. So this is a huge jump, right? And I think we still live in a world where we think, okay, most finance happens in the regulated financial markets, and over here there's these alternatives. They're maybe pretty risky, but they're not going to affect most people. And I think what's happened is because this barrier has fallen, we have to be so much more concerned about what the risks that's happening in the private side of the financial markets, how those could affect all of us, right? Why did this happen? The shift really began in the aftermath of the financial crisis and escalated very, very quickly. It was due to many factors happening all at once. Changes in the requirements on the banking sector, which were necessary after the crisis in 2009, that led to non-bank financial institutions seeing opportunities for themselves because the regulations that were put in place in Dodd-Frank didn't affect them in the same way. We've also had rapidly improving technology, years-long low interest rates until recently. We had the pandemic. Those have all played a part, but so too has trying to apply an outdated regulatory framework, right? This framework we inherited from the New Deal to solve the problems of this larger unregulated financial system. So, for the non-financial corporate sector, companies that, sell goods and services, we've seen a major shift in how they finance themselves, meaning whether or not they go through what you hear this terminology, an IPO, right, an independent public offering. We've seen a real shift in companies not starting to sell their stock on the open stock markets and stay private, right? And we've also seen these companies start to borrow from these private credit funds, right? The focus of what we're talking about today. So let me define private funds generally, and then we'll finally get to your question, Natalia, what are private credit funds specifically? So what do we mean by this term private fund, right? Under our financial market regulations, in sort of simple terms, we allow these things called funds to pool together the money of many individuals and groups of individuals. In our case, in the United States, a lot of those funds themselves are aggregating the money that we as employees may be saving for retirement through our employer or through another vehicle, right? This is our pensions, our 401ks. There's about $13 trillion of this kind of retirement savings in the United States right now that needs to be managed. Funds themselves have to be managed by fund managers, right? And those fund managers are required to disclose certain information about their activities unless they meet certain criteria that lets them fall into an exception to the rule for disclosure. So when we're referring to private funds, what we're talking about is the type of funds that have fit themselves into these exceptions, right? We have lots of types of funds that do a lot of financial disclosure, mutual funds, other types of funds that we're familiar with. Private funds are the ones that traditionally have not been as available to the public, right? They were walled off from everyone because they were able to engage in more risk, and they limited themselves in certain ways, whether it's the number of participants or who could invest in them directly. And so they were considered private and got this opportunity to not have to disclose by saying that they would not allow the ordinary household to simply purchase a share of them. So what's happened over time is that the dynamics of private funds and their relationship to the rest of the economy has really shifted. A first major shift was that institutional shareholders like pension funds and endowments were able to start to invest in private funds, private equity funds, primarily at first. And this change has had major impacts on, for example, public pension funds, right? So I'm a public sector employee at the University of Massachusetts. I'm a member of a public pension fund. And our public pension funds have started to put more of their overall portfolios in the last many years into these private funds, right? This is up to about 9.5% of their total assets pretty recently. But generally, regular everyday people who are not wealthy, you might have a pension fund that's investing for you, but you could still not go and buy a share of a private fund yourself, right? That was where the limit was. And we'll talk in a little bit about how those limits are starting to fall. So what are private credit funds, right? We've heard, as I said, I think a lot of people know about private equity funds. Those are these types of funds that go and buy a business, right? They are holding the equity of a company. Usually, almost always, they're purchasing that company with a lot of debt, and then they're holding that company with the intent to sell it for a higher price than they bought it to make money. And there's a lot of, I think, important work that's been done by a lot of people, including at AFR, to point out the real harms of private equity on companies and on workers and on society. But we've also seen in the last several years the rise of private credit funds. And in sort of simple terms, private credit funds are the same type of fund that can take in money from institutional shareholders or from wealthy accredited investors. And what they do is instead of holding the equity of a company, they lend to a company, right? So they're simply a non-bank financial institution that's making loans. And they're lending, this is not a new practice, it's gone on for a long time. But what's concerning has been the rapid growth and the rapid importance and centrality of these loans to certain important sectors of our economy. So I'll pause there.
Thank you so much for that overview, Lenore. Can you say a little bit more about what makes private credit risky? You already hinted at this and the opacity of it all, but can you dig in a little
Yeah.
bit more?
Yeah. So, they're, in essence, they do not have to disclose most of the time. There are exceptions, but they don't have to disclose their loans. And so, unlike a regulated bank where you have, at least we've had until now, regulators sitting within the banks themselves, actually making sure that there is standards that are held to in terms of verifying the lender that they are verifying that the borrower can actually meet the conditions of the loans. All of that activity is happening in private, right? It's not disclosed. So private credit has grown from $500 billion in 2015 to about $1.8 trillion in 2024, with maybe $1.3 or $4 trillion in the United States. There's a lot of different numbers out about the scale of the private credit fund sector. Globally, most of it is concentrated in the United States, but there are assets outside of the US as well. There's projections by some people, including financial institution leaders, that it will grow to about somewhere between 15 to 40 trillion dollars by 2030, right? That's a pretty big scale. The point is that this is a growing sector. And up until pretty recently, everybody who was part of the private credit fund sector said that, this was the best thing since sliced bread. These types of loans were, so necessary at a time when banks were not sort of nimble and agile. And so we had to see, the rapid growth of this sector to support our economy. So what are these institutions that are doing these loans? You have asset managers like Apollo, like Blackstone, others that are less familiar but are really central in private credit, like Blue Owl, that's been in the news a lot recently. What they're doing essentially is they are managing funds that take in money from institutional shareholders and wealthy individuals, and then they're lending it to non-financial businesses most of the time. The terms of these loans are bespoke and not disclosed. And importantly, the value of the company and the value of the loan over time is determined by the lender, right? There is no public market where these loans are being, their value is being determined. So one other just sort of piece of the puzzle here is that a majority of the loans, at least until maybe recently, of private credit funds are going to private equity-backed companies. In other words, private equity is finding the leverage that it needs to take over a company, the debt that it's always used to take over companies in the going private transaction. It's now getting that money not from a regulated bank, but from a private credit fund. So that brings me to, one risk is just that there's a real set of interconnections happening between the banking sector and the non-bank financial institutions that are lending, as well as the non-bank financial institutions that are, that are buying out companies that are now holding the loans. So there's been a lot of work actually by a whole set of financial regulators, the Federal Reserve in the US, the IMF, that have started to raise concern about private credit funds, specifically on this point of banking system interconnection. So banks have lent, according to one report, $300 billion to private credit, equity and credit funds in the last year, which is, again, all these numbers have gone so far up. That's up from 10 billion in 2013. So from 10 billion to 300 billion, right? That's a huge set of interconnections. Another set of risks that, again, we'll talk about more because they're starting to come out as a major issue is that these loans may not be able to be serviced by the borrower. And then all of a sudden, there is a concern about how much the loan is actually worth. And do the institutional shareholders who are participating in the fund, are they going to get their money back, right? Are the loans going to be able to be repaid and worth what they had been, committed to, what they've been promised they would get back? So there's a lot of different issues that can come up in terms of if a borrower can't repay the loan, right? One type of concern is that companies are now, with private credit funds, much more able to kick the can down the road, meaning that if you're unable to service your loan, you don't have the funds to pay it back, you might be able to restructure it, which could be a good thing if your business is in a certain type of circumstance where you have a short-term crunch, but you will be able to make good on the loan later. That could be a good thing. But on the other hand, it could be a situation in which, rather than the private credit fund would have to mark down the value of the loan, admit that the loan actually isn't worth what they thought it had been worth, they can sort of keep pushing that problem forward and let the company essentially roll over its payments into its total amount that it owes over time. because there's no disclosure requirements for most of these loans, there's really not a lot of information out there about how much this type of rolling over is happening. And then there's also just, of course, the risk that because many of these loans are concentrated in certain sectors of the economy, and as we'll talk about in the software, you already hinted at it, the software sector, now that we're having the software apocalypse, which we'll define for people who don't know what I'm talking about. When loans are concentrated in certain sectors, you can have a situation in which all of the sudden a lot of loans start to go bad at once, right? And so that's not just a problem of an individual loan all of a sudden being worth a lot less, but it can mean there's sort of a spiraling downward effect that happens when all of a sudden loans in a whole sector are become more suspect, right? Um, and then I'll just mention one other problem, and then we can talk about more of them in detail. But I think that generally we have to remember where the money is coming from that's being utilized in these private credit funds and in private equity. There are real risks to our retirement security, right? If the sector is not doing well, then those of us who have, through our own institutions, put our retirement security in the hands or partially in the hands of the sector, if things go, badly, it is mostly our money that will be at risk because the structure of these private funds means that the fund managers actually put very little of their own money into the fund, right? So that's a third type of risk that I think is part of why this is so important to me.
Thank you so much for that, Lenore. And to get a little bit more into that, can you say a little bit more where private credit gets its money from? Like, who are the investors in private credit funds? You mentioned
Yeah.
wealthy individuals, you mentioned pensions, you mentioned that they're trying to expand the investor base. So can you just go through some of those categories and why they're important?
Yeah. Yeah. So public pension funds are a huge pool of assets, even though our private sector, or I'm sorry, our public sector workforce has been so under attack at the federal level under this administration. We still have a very robust public sector at the state and municipal level. And so the retirement savings of public sector employees are aggregated into pension funds such that the individual worker is no longer at risk because we're supposed to get a set payment at the end of our working life rather than have just an account that can fluctuate with the market. Anyway, so that's public pension funds. Public pension funds have a fiduciary duty to make sure that retirees are able to retire in dignity and receive the payment that's been committed to by their employer, by their state or municipality. And so they have all kinds of rules around what the managers of the pension funds themselves, not the asset managers of the credit funds, but the managers of the pension funds. There's all kinds of rules about what they can put their money into, right? And over time, there has been real limits in place that really were about risk management, saying, okay, it may mean that there's some loss in terms of, taking a risk that could lead to a really high return, but the downside of that risk is actually quite damaging because the retirees are depending on this for a secure and dignified retirement. So there was limits on public pension funds being able to invest and have as part of their portfolios these riskier assets. But that has mostly, there's been many legal changes and things that have happened, as well as a lot of lobbying by the private equity and private credit fund industry to have public pension funds increase the percentage of their portfolios that are in private fund assets. Again, I think people have heard more about private equity funds, but private credit assets have made also up an increasing percentage of the portfolios of private credit funds. So just one example, a 2024 survey of about 500 of the public pension funds in the United States said that private credit had gone from 0.7% of overall public pension fund portfolios in 2021 to about 4% in 2024. But this really masks a difference where many of the largest public pension funds have a much higher allocation to private credit funds. and have in some cases been aggressive in moving more and more money into private credit funds in the 2020s, right? What's interesting, though, is that in the last maybe year or so, we've started to see some really important questions being asked by public pension fund leaders about whether or not this is the right approach for their fund. So we've seen some public pension funds increase their allocation to private credit, and we've seen some decrease their allocation to private credit. So it's going in both directions. But I think it's just important to remember that this is, if you're a public sector employee, this is your money that you've earned through your work that's going into these funds with the idea that it's going to support your retirement security down the road. And we have the right to ask questions about whether or not that's really true. Another major player in private credit is insurance companies. So insurance companies also have a role in reducing risk, right? They're structured so that if you hold an insurance, they're structured so that they can make sure that if we have a disaster happen to us, that we can be made whole, right? It's a way to smooth out risk across a broader population. But insurance companies themselves, when they hold all of the money that we're putting in on a regular basis, they also invest it as into a portfolio of assets for it to go up in value over time. So people often don't think of them as major players in the financial markets, but they are. They're major institutional investors that play a very central role. They're complicated in the United States by the fact that many giant private equity fund managers or asset manager companies have been buying up private insurance companies. So now the insurance companies themselves have become part of the sector in another way, such that private equity companies have access to the money that insurance companies are holding and can direct it into funds to be allocated in private equity or private credit, right? So again, this can get really complicated. So for folks who are not as familiar with this stuff, I'm trying to stay away from jargon, but it's a complicated setup a lot of the time. An example of this is that Apollo, which is a major private fund manager, major player in the private markets, owns an insurance company called Athene and directs its portfolio, right? So insurance companies are interesting because they're highly regulated in the United States for good reason. So their portfolios have to be backed by solid assets, enough solid assets to cover, certain set of insurance claims that could come up. And what's interesting about them is we're starting to see as they go more and more, their assets are put more and more into private credit funds. We see the rating of these loans happen such that these loans are being rated as, very, very safe and secure. Right. And this has brought up a whole set of questions about, well, who's doing the rating of private credit fund loans that we could talk about if people are interested. But that's another major player in where the money is coming from. There's endowments, there's sovereign wealth funds. But I think one piece of the puzzle that's become increasingly important in just the last year and again in the last couple of weeks is retail investors themselves. So there's really two parts of this. One is the fact that wealthy individuals or households have been able since, for the last 100 years, if they met certain wealth thresholds, they've been able to invest in the private markets directly. That's the idea that if you are wealthy enough, you are a sophisticated investor. It's sort of a tautological definition of you're sophisticated because you're wealthy. But the idea is that you can bear the risk, right? And so you don't need to be kept out of these very risky parts of the financial markets. So those sets of retail investors have been holding an increasing amount of their portfolios in private credit assets. What's complicated about the private credit funds is that there are also some of them that are themselves publicly traded, where retail investors can purchase a share of them on the open markets. So this is a complicated institutional structure, but there is more and more potential exposure that retail investors have to private credit. And then what's coming, and I think we'll talk about in a little bit as well, is this proposal by the Trump administration that 401ks are individual employer held retirement accounts, so distinct from a public pension account, but probably what most of you who are fortunate enough to have a retirement account have is a 401k. Those accounts have also, just like public pension funds used to be, been limited because of the idea that this is people's precious retirement security. And so you don't want to open it up to too much risk. And so there have been limits put in place on what could be considered as prudent for a manager of a 401k to hold in a portfolio. And they held the publicly traded stocks and other types of assets that were considered less risky. What's happened now is that the Trump administration has said, no, 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 in the name of democratizing finance, right? The ultimate ironies, democratizing finance, we're going to make sure that 401ks can get exposure to these private credit funds as well. And so that's a big switch that we're starting to see.
Thanks, Lenore, and definitely want to get more into that push to open up the 401ks to private markets. But before we get to that, we've already alluded to the fact that private credit has been in the financial news a lot recently and very much not in a good way. So I would love it if you could talk a little bit about some of that recent news and what it says about what the risks look like concretely in practice as they're currently unfolding right now.
Yeah. So there's so much we could say here, and I think probably news has broken in the last half hour that we have not seen the way this is all happening. But so there's a couple different things that have been happening really just in 2026 or at the end of 2025 that have caused a lot of increased worry about private credit funds. So one thing that started to happen was that it came up in the fall in several different deals that the due diligence that private credit funds were supposed to be doing really wasn't being done well enough because companies were able to really engage in massive amounts of fraud, right? The fraudulent dealings are colorful stories that we could tell. But basically, the concern was that private credit funds, because they don't have the disclosure requirements or the many other requirements that a regulated bank would have, they just simply weren't engaging in the due diligence that they should be. And so they were making loans that all of a sudden companies were going bankrupt after trying to, engage in fraud for years and years. And so the funds were being left with nothing to recoup, right? There was no way to make up the value of the loan. So that was where we were in the fall. And we had Jamie Dimon talking about cockroaches. And, we're starting to see some cockroaches come out into the light. But there was sort of a sense that, okay, this is maybe, a couple bad actors, right? And we should be more diligent about it, but it's not a sectoral problem. And, of course, there's fraud that happens, all over the place in the regulated sector. And so we need to just, pay attention and crack down on fraud. What's happened in 2026 is a little bit different. We've seen over the last, 6 or 8 weeks, a rise in attention to how AI is going to massively shift our economy. And there's been what people have referred to as like a software apocalypse, meaning that all the companies that were supposed to be the innovative software and tech companies of the future that private credit funds had engaged in lending to so heavily, all of a sudden, the worry is that AI is going to make a lot of these software as a service types of companies irrelevant, right? They're going to disappear because now AI can do everything that they could do without, at a fraction of the cost. And so software company loans in the US were a major portion of what private credit funds were engaged in. And all of a sudden, there became a real concern that these loans were not actually worth what they had been valued at by the private credit funds. The software collapse also happened in the public stock market. So this wasn't just a private credit fund story, but it led to a lot of concern about private equity firms and private credit funds that had been heavily exposed to these software companies, both seeing maybe short-term defaults, but more importantly, maybe seeing in the long term these loans just being not worth any, much or anything as AI really shifts our whole economy. What also has happened at the same time is that because of this type of concern, but also other, other types of concerns, there has been a sort of noted increase in investors wanting to take money out of these funds. So the way that these funds work, as I said, there's like a bunch of different institutional setups that are complicated to get into all the details of. But one type of fund is structured in such a way that, okay, if you want to withdraw your money from it, you have an opportunity once a quarter to withdraw money by the fund itself, essentially buying back your investment. And the funds themselves have a limit of how much they will let investors take money out of the fund in any given quarter because they don't want there to be a run on the fund, right? They don't want all of a sudden the fund's investors to all get spooked at once and take all their money out. That's essentially what happened at both Blue Owl, which, as I mentioned, is I think a great name, a less well-known asset manager that's really focused on private credit, and as well at Blackstone, which is, of course, one of our most important financial institutions, a major, maybe one of the most important players, certainly in the private financial markets, but significantly holds the largest private credit fund. So the BCRED, which is the Blackstone Private Credit Fund, is about, at least it's a little bit outdated, but I think it was about $77 billion. And it's more than twice the size of its next biggest rival. So it's really a major player in the sector. It had a ton of its portfolio or loans were made to software companies. And so all of a sudden, there also started to be a lot of concern about what was happening inside this private credit fund and should investors try to take money out of it. This is a good point just to emphasize that the universe of private credit funds, there's a lot of them, but a very small group of them make up actually a lot of the lending itself. So this is according to PitchBook, which is a data vendor for private markets. The largest 10 funds account for more than half of all assets under management, right? So you have a lot of maybe small funds, but you have a very concentrated sector at the top. And a fifth of the entire sector is accounted for by just these two funds, right? Blue Owl's Credit Income Corp and Blackstone's BCRED, right? And so you started to see concerns about these two funds. It's worth just saying again that throughout 2025, I was fascinated by the fact that, the IMF, the Federal Reserve, many European banking regulators, certainly Senator Elizabeth Warren, and, when we still had the Biden administration financial leadership, they were all calling attention to the structural problems of private credit funds. But what we're starting to see now is the financial industry leaders themselves start to express worry, right? So we're seeing these moments in which investors want to take out more than is limited, than the fund limits them to take out. And that's a story that once people start to hear it, of course, they too want to take their money out, right? Nobody wants to be the last one holding the bag. So we're seeing this kind of sort of escalating problem in specific private credit funds. And we're also seeing several high-profile write-downs of loans made to these software companies, where all of a sudden the loan that was supposed to be worth a lot more, the private credit fund says, actually, no, we have to mark down the value of the loan. And so that also spooks everyone out. So there's been, a lot of stories just in the last 2 weeks. What we can see publicly is, just one thing to clarify again, to add to the complexity, many of these major private financial institutions, they are companies that, as their own companies, they issue their own stock on the financial markets. So they have a stock price, even though they're doing their activities, their business is on the private side of the financial markets. They themselves are publicly traded. So that can get, people can be like, how is this set up? But it's because they are companies themselves. But the reason why I'm saying that is because the stock price of many of these largest private asset managers, Blue Owl, Blackstone, Ares, KKR, their own stock prices have been falling, right? They have been people, shareholders on the public markets have become very, very worried, financial analysts raising all kinds of alarm bells, and their own stocks has fallen. We also have, again, this complicated structure where for private credit funds, there's a certain type called a business development corporation, which is a private credit fund in the sense of making non-bank loans. They're not a bank. They're making loans to businesses through a private credit fund. But the fund itself is also publicly traded. So we can also see their stock price. And the stock prices of those BDCs, the business development companies, corporations, are also falling. So in general, we've seen in the last couple of weeks, and this is before the war in Iran started, right? This is not a result of what's happened in the last couple of days, although certainly that's adding major stresses to the economy. But before that, we've saw the stock prices fall of these major private asset managers. We saw the stock prices fall of some of the BDCs, the actual publicly traded private credit funds. And we've seen rising redemptions, right? Requests from investors to take their money out, such that even a story that's been, I think, circulating a lot just since yesterday is Blackstone reached the point with their credit fund where they actually had to tap their own senior management to put money in as individuals to shore up the asset class. And I think I saw a quote online, I think from Corey Freyer, who may be on here, that saying that this is the equivalent of when the parent is spending, $1,500 to buy all their kids' Thin Mints, right? This is not how it's supposed to be, right? So what's happening is that the funds are getting very, very nervous. And so in this case with Blackstone, they got their, I think it was like 25 senior managers to step up and put, I think, $150 million into the fund, which just is a sign of, insecurity that I think is going to make this whole sector continue to be, unfortunately, extremely problematic.
Thank you, Lenore, for covering so much of the recent news here. And you mentioned, no one likes to be the last one holding the bag. So, speaking of which, can you say a
Yeah.
little bit more about the industry's push to get retail investors to invest in private credit and other private market options, including through their 401ks, and why and how the industry players in the Trump administration are attempting to do that?
Yeah, yeah. So this is where we haven't talked here about all the problems that are building up in the private equity sector as well, but these are all, of course, related. But I think what's happened is that the Trump administration has decided or been organized to do so by the private financial sector, has decided that this is a great time to say, okay, all the limits to risky holdings that we've put on the 401k sector, this is a great time to get rid of those limits, right? Because if you have the institutional shareholders and the wealthy shareholders getting out of this market, well, where's the money going to come from? Some money's got to come in, right? I mean, this is maybe the most cynical take on it, but that's the confluence of factors that's happening. They're saying, let's open up 401ks to not only private funds, but also to crypto, which also has collapsed recently. They're saying this is the best time ever to make sure that we can democratize finance, right? If you go and read their executive order from last August, they say essentially that we are keeping the American people from these, wonderful wealth building opportunities. And this goes back to where I started. I think the big problem with the whole way in which private markets are being framed is that we've forgotten why there were these limits put in place in the first place, right? There's really no discussion of, okay, we take down the barrier. Why did we have this barrier? What was the reason? What was the risks that we were trying to keep away from the majority of the American people, right? So they framed alternative assets, just another way of referring to private financial markets, as a barrier that must be breached, and we need to let employer-sponsored defined contribution plans, 401ks, in. They did an executive order. The Department of Labor changed its rules. And what's happening now is that you then saw Blackstone, BlackRock, many other financial institutions set up units to support 401ks to put their money into private markets, private funds, and crypto. What's happening now, I think, is that hopefully a smart manager of a 401k is going to think about their responsibilities and what they could be responsible for or liable for if they put funds in, if they put the 401k assets into these private markets and then things go south, right? So just by doing an executive order, the Trump administration can't make 401ks change their portfolio allocation. So really now it is a question of what the 401k managers themselves will do, which is the same type of question that faces public pension fund trustees, faces people managing university endowments, life insurance companies. What is going to be the most prudent thing for us to do with this money, with the money that we're stewarding, that we're managing on people's behalf? Is it to engage in these more risky investments with the potential chance of financial upside? Or is it to, especially at this point when things are really not looking great, to take a hard look at the long term and think about what's really the best approach?
Great. Yes. Very related to that. So what recommendations would you have to those folks managing like pension trustees, like those managing endowments, and also just retail investors, like regular people who are also trying to think about where to put their money?
I think we need to ask a million questions, right? I think that when a private equity fund or private credit fund, for example, comes and presents to public pension fund trustees, there's a real need to ask, well, where is the data coming from that you're saying your fund is going to outperform the public stock market? There's tons of academic research that shows that there's all kinds of problematic ways in which private equity funds and private credit funds can report how much their funds are growing or their rates of return. And so I think just at the most simple matter, don't take their word for it, right? We have to actually investigate and understand for ourselves what the real risks are. I think we need to keep putting pressure on, it's a nonpartisan event, but we need to put pressure on policymakers and elected leaders from all parties to say, crypto and financial funds are creating a lot of risk potentially in our economy. And so, what's the policy agenda? We need to keep pushing forward for a more holistic policy agenda rather than a reactive one, right? I think we need to think both in the short term, with the tools that are available to us. How can we make sure that our own institutions, 401ks, pension funds, others are not taking undue risk? And then over time, as we rebuild political capacity and political will, we need to make sure that the fund managers have not captured the imaginations of our policymakers.
Thank you so much for that. So I think we can now get into some audience questions. We also had quite a few submitted when folks were registering. And one of them talks about the fact that private markets are one of the ways that pensions and other investors can make investments in climate solutions that deliver needed capital to companies transitioning, retrofitting, and building low carbon infrastructure. And how do we reconcile this?
Yeah, so I think that there's a real question about if they have the financial incentives to invest in renewable energy sector. Maybe in certain cases they do, but in other cases, what we're seeing is that, for example, private equity funds are holding more and more of the oil and gas assets that are being transferred out of the public stock markets, precisely because there's so little disclosure of what they're holding. So I think we have, a real need for, obviously a reversal of where we're going in terms of turning away from building a renewable energy economy. And I think that, this is also where I think it can get confusing. The word private can be confusing because I think there was a lot of conversations during the debates over the Inflation Reduction Act and through the Biden administration's industrial policy agenda that said, okay, the public can't do all the investment to make the renewable energy sector happen. In that case, what we meant by public was government, right? And so we need the private sector to engage. But that's a different point than should the engagement happen on the private side of the financial markets, the less regulated sides of the financial markets. So I think, getting into how we would actually, continue to build out the renewable energy economy is a different question, and certainly an important one. But I think we need to really think about the risk that would happen if we put the majority of that type of real investment in the hands of private financial institutions. And there's a lot of work that has been done, research and campaigning that has already been done, to show just how private asset managers actually holding utilities and other types of real assets destroy those assets or really reduce the value of those assets, because their goal is not to invest in them and make them better. Their goal is to sell them for more money in a set of years. And so how do we actually make sure that we're not seeing asset stripping or the types of behavior that we've already seen from asset managers when they're engaging with some of our most important utilities and other components of the renewable energy economy.
Thank you so much for that. So the first attendee question we got was someone who said they're very interested in the nexus between AI and private credit, and can you expand on that in greater detail?
Yeah. So there's great work that's happening on this, and I think this can and should be a whole other webinar. But the growth of data centers are also fueled by debt, right? There's a ton of lending that's happened both from more regulated lenders and also from the private credit fund and private sector itself. So the nexus of AI and private credit really works in a couple different ways, because there's both what I was talking about in terms of the changes that AI is going to make in terms of making perhaps other sectors of our economy that are holding a lot of these loans, make them less valuable, put them out of a job in essence, right? That's the worry about the software apocalypse. And so that's one effect in which the private credit funds could be left with loans that are not worth nearly as much. But then there's also a whole set of loans that they've been making to the data centers, right? To this enormous growth. And some of this has been happening through private equity as well. Blackstone and BlackRock have both been engaged in a ton of deal making to buy up and to lend to both data centers, but also utilities, the types of electricity utilities that are going to be so important for the data centers to be able to grow and to, unfortunately, in my view, utilize a ton of our electricity. And so that's another set of risks where if they are also overvalued themselves, that could be another set of loans that end up not being worth nearly what we thought, or loans where that if we see, cascading decline in the AI sector, you could see loans suddenly become much less in value, or you could see companies not be able to pay them back. I think a third related component of all of this is, of course, we all are sitting in the middle of this horrific moment with war in the Middle East, and we have to ask what the impact is going to be on energy and energy prices in the United States and around the world. And though that's not, I think that it should not be the main concern when we're thinking about what's happening right now in Iran, it's also a concern in terms of thinking about how all of these different assets that have been valued highly, what happens when the energy costs escalate or skyrocket? Are they still worth as much, right? Are we going to see AI production grow as quickly as everybody anticipated?
Thank you for that. And we have a question here about the extent of the contagion that might exist to the banking sector. You mentioned that there was more and more
Yep.
intermingling there between the regulated banking sector and private credit funds. So can you expand a little bit on that?
Yeah, there's been some great research by the Federal Reserve Bank of Boston, for example, and by the Bank of International Settlements showing exactly what the interlinkages are. Because the regulated banking sector has to disclose so much data, right? We actually have a much better sense of how the regulated banks have become intertwined. And the short answer is really just that the interconnections have grown very, very rapidly and are very complicated. Right. So in some cases, they're going on loans together. In many cases, the regulated banks are, instead of making loans to non-financial companies themselves, lending money to a private credit fund, which then extends the loan. And then there's, other, because our financial institutions are so complicated behemoths these days, we have other types of interrelationships where they're creating even new types of asset classes or, new entities jointly. So you have banks and non-bank institutions working together to create new types of setups. So there's a lot of interlinkages, and this is where I think under our current policy apparatus, we should really be advocating for our financial regulators to do as much as possible to look at the systemic risks that are emerging. I mentioned before that, in 2025, you saw the IMF, the Fed, others really calling attention to this. And you saw the Federal Reserve actually did what they called a synthetic stress test to essentially look at what might happen to the banking sector if the non-banks started to collapse. You see some of that happening in Europe now too. But what's important for people to keep in mind is that within our current setup, many of our regulators, they only can regulate a certain part of our financial institution. They are not the regulators of private credit funds. And so the interlinkages is one way that we can actually have some regulation be at least indirectly addressing the problems that might pop up in private credit funds.
Thank you for that. So we're running out of time, but one more audience question. We have someone who's interested in how they can tell whether or not their pension funds have a stake in private equity or private credit.
Yeah, so if you have a public pension fund, they're required by law to disclose in regular reporting what they're holding. It can be complicated to get that information and to figure out how to sift through it, but at least know that you do have the right. For if you're holding a 401k, it's not the same type of public disclosure, but you should feel empowered to ask questions, right? You can go to your employer who will then direct you to an asset manager. If you're holding a 401k and you're getting, your statement and you're not sure what all the acronyms mean, you have the right to call up and ask, how it's being allocated, and you have the right in most cases to change that allocation. So I would say, really address questions at your own, whoever's managing your money, as much as possible. Don't feel disempowered by all the jargon.
Thank you. A very related question is, as someone who said we're already invested in private credit, and what are the most important questions we should ask when contemplating an investment in private credit? Are there any particularly bad actors we need to be aware of? Some more questions on like how to get to those hard questions.
Yeah, I think right now, I think that asking, how are they actually making sure that the value of the loans is what they say it is? What is the process by which they conduct, the valuation and the due diligence? There was actually just a panel at the SEC that was online earlier today about this exact question, and I did not find the answers very satisfying. So I would maybe, there's lots of specifics, but I'd say in short, just keep pushing to get clearer answers, and then feel empowered to advocate that maybe this might not be the best choice for your public pension fund. That's a totally acceptable position to take.
Thank you, Lenore, so much. We have so many more questions, so we'll have to do a follow-up. But really appreciate, Lenore, all the expertise you shared with us today, and everyone for joining the discussion. And please keep a lookout for a follow-up email from us with the recording and other resources. So thank you so much. And
Great. Thanks everybody for participating.
thank
Thanks,
you.
Natalia.